Hello all, and welcome to the launch of the 2025 edition of OMFIF's Global Public Investor Report. My name is Nikhil Sangani. I lead OMFIF's Economic and Monetary Policy Institute and am proud to have led the research for this flagship publication with our excellent team of in-house economists at OMFIF. The Global Public Investor, or GPI, has been the cornerstone of OMFIF's research and our longest-serving publication, having started in 2014. This publication has been used to track the most important trends in central bank reserve management for more than a decade. Over the years, the publication has evolved, and at the heart of our report now is an annual survey of central banks on their investment strategies. We're very proud that 75 central banks across the world, with more than 5 trillion in reserve assets combined, have participated in our study this year. This year, we also include results from a short poll of public pension funds and sovereign wealth funds to compare how this important group of public investors are reacting to very similar pressures of market volatility and uncertainty, and comparing those with the reserve managers. So overall, this year, we capture the views of 90 official institutions with over $7 trillion in assets combined, and we'd like the chance to thank each and every one of them for their contribution to our research this year. Now, very shortly, I'll be handing over to my colleague Yara Aziz, an economist at OMFIF, who will be taking you through the key findings from this year's report. Also, over the next 90 minutes or so, you'll be hearing from representatives of central banks and various market experts about how official institutions can look to navigate these difficult market conditions. Now, when we take a step back and look at some of the key trends from this year, we labeled the report Shaking Foundations, as it appears that two of the main trends that have underpinned global financial markets in recent decades, that is, globalization and the dominance of the US dollar, are perhaps now being undermined. Now, without giving away too many details from what we found in our report this year, it is very clear that geopolitics is becoming an ever bigger concern for reserve managers and global public funds, and many are now eyeing some alternatives to the dollar. That includes the euro, perhaps the renminbi, and in particular, gold. This seems to be shining bright to provide diversification and a safe asset to many official institutions during these uncertain times. Yet for many of the survey respondents in our study this year, it appears too early to call time on the dollar's dominance, and perhaps US exceptionalism more broadly, given the continued depth and liquidity of US markets and perhaps the continued innovation in the US economy. So generally speaking, the trend we see is one of gradual diversification rather than widespread de-dollarization over the coming years. Now, we'll be very shortly digging deeper into some of those findings, both in the key findings presentation and with a panel of experts. But first, I'd like to hand over to one of our key partners on this project and long-standing partners, Frank Scheidig, Global Head of Executive Banking at DZ Bank, and also a Deputy Chair of OMFIF's Advisory Council, for some introductory remarks. Frank, over to you.
Nikhil, well, thank you very much, and good morning, good day, good evening to all of you, wherever you are in the world at this time. Yeah, proudly to say for the 12th year we're supporting you guys, and I think it's a fantastic report. GPI gives us at least a good window of how global public institutions, i.e. like central banks, public pension funds and funds are acting. It might not reflect 100% what happened since Mr. Trump is the second time in the Oval Office and has definitely put a lot of volatility to markets, also on unexpected short notice. But one thing is crystal clear also in that survey, the peak of the dollar and the total amount of reserves is over. It's given up to alternatives, not just on the real currency side towards to the euro and the renminbi, as well into alternatives like gold. No surprise, we might see on the 13th survey next year that more clear. The euro is not yet the alternative, therefore we definitely would need to do some homework. That means all banks who are regulated, not just the European banks, as well the Americans, given their big balance sheets, it will work out anyway, mostly in their favor. Having the euro in place with more volatility we've seen in these markets, but the euro needs to provide all those financial institutions more liquidity on the bid-offer spreads as well, and interest rate swaps and cross-currency swaps. If that happen, and I predict it will happen, we will see a clear tendency. I don't see ever the euro or the renminbi has a potential to take over the role from the US dollar, but it will give us a chance to bring this world in a better balance. Unlike the US, Europe and Asia have never used its currencies blocks as weapons. I wouldn't say that this is necessarily the main aim for the US, but effectively the way they have treated the dollar over all the last decades after World War II speaks for itself, and it gives the rest of the world now a chance to seek for alternatives. Even the dollar, I will predict, will remain its role, no doubt about. But also towards to the emerging market development, at one day we have to accept and support also from that side local market currencies, which is not part of that survey, but we might, Nick, will do so over the next years, and will pay more attention, and who will know which currency which we haven't asked for will show up and gives us a little inroads. Nevertheless, I'm looking forward now for more details. I will hand back to you, and thank you very much. We will support that further. I think, as I said in the beginning, it's a great survey, and happy to discuss that also on the next OMFIF boards and for sure conferences we will see and have ahead of us. Thank you very much.
Great. Thank you very much, Frank, for your insightful comments, particularly on the euro, and for your continued support on our project and research at OMFIF. I think we've waited long enough to hear about some of the results, so now's the time to show you all what our key findings are from our research this year. So with that, I'll hand over to my colleague Yara Aziz to take you through the key findings.
Hello, everyone. My name is Yara Aziz, economist at the Economic and Monetary Policy Institute. It's a pleasure to be here with you today to present the key findings of OMFIF's Global Public Investor Report 2025. This report has been running since 2014 and continues to evolve. It explores trends in FX reserve management based on surveys from 75 central banks with over $5 trillion in reserves. The survey was conducted from March to May and captures the immediate response of tariffs and Liberation Day. The report is also supplemented by a short poll of 15 major public pension funds and sovereign funds in our network with $2 trillion in AUM. So overall, the report includes insights from 90 official institutions with $7 trillion in assets, which gives us a sense of what major official institutions in the market may do. The primary focus is on central banks. So let's look at what central banks are thinking in terms of short-term macro trends. So geopolitics is moving to the forefront of their thinking. This chart shows what central banks say is the most important economic factor shaping their investment over the next 12 to 24 months. The dark blue bar is for the year 2023. The light blue is 2024, and purple is 2025. We can see that geopolitics has jumped to over 30% from 4% a year ago. Short-term policy rates remain at the top in the near-term driver, while inflation is seen as less pressing than in previous years. That said, these factors are often deeply interconnected. Looking closer at geopolitics, our findings also show that it is the most important concern for reserve managers in the next decade. Among the different risks, 96% flagged tariffs as their biggest concern. So, what is the overall message? Geopolitical risk is more acute and here to stay, and this is filtering into the reserve management plans as well. This table shows how reserve managers expect to adapt strategies over the next 12 to 24 months across a few criteria. Firstly, they are diversifying their portfolios. You can see right away that 58% say they plan to broaden their portfolios. Second, 54% are planning to increase the size of their reserves. That's likely a response to the heightened uncertainty and a desire to build buffers. Third, 20% say they're focusing more on liquidity, so planning around potential intervention or volatility. And finally, risk. Only 11% are increasing risk, while 14% are scaling it back. That gives us a net of negative 3%, compared with a net increase of 23% last year. It's also consistent with the broader sentiment. 49% of central banks are bearish on markets, and just 3% are optimistic. The message here is pretty clear. Central banks are looking to protect themselves with less risky, more diversified, and larger reserves. And part of that diversification story, of course, is currencies. So as sentiment towards the dollar fades in the short term, the euro is rising in prominence. This chart shows how central banks are planning to shift their allocation to major currencies over the next 12 to 24 months. The dark blue bar going up represents the share expecting to increase exposure, and the light blue bar going down show the share expecting to decrease, and the diamond marks the net result. On the left-hand side, you can see that the euro tops the list, followed closely by the renminbi. And around 15% of reserve managers on net expect to increase exposure in both, and that's a notable jump from last year. And further to the right, the dollar much lower down the pecking order. There's a barbell dynamic here. Some still see it as a safe haven and want to add, but almost an equal number plan to cut exposure. That leaves the net roughly flat. That's a major shift from last year, when the dollar was the most in-demand currency. But over the long-term horizon, the renminbi leads, with about 1/3 of central banks expecting to increase allocations. The dollar is the second most in demand over the long term, and in net terms, both the euro and the yen come out ahead of the dollar. So this isn't about a rapid de-dollarization, but more about gradual diversification. But why is that? So clearly, the US political environment is weighing on sentiment, what we might call as the Trump effect. This year, 70% of respondents said they're discouraged from investing in the dollar because of US politics. That's more than double the share from just a year ago. So what does that mean for the dollar's long-term role? When asked what they expect the dollar's share of global FX reserves to be in 2035, central banks gave an average of 52%, down from 58% now. So over 80% of reserve managers state that the dollar still delivers on central banks' two main priorities: liquidity, which is cited by 93% of reserve managers, and safety, cited by 81%. Although there is no real alternative in terms of currencies, gold may be seen as a bigger diversifier now, and we'll see this in the next slide. So central banks are going for gold. This chart shows sentiment around gold allocation, similar to what we saw for currencies. This year, over 30% of central banks say they plan to increase their gold holdings. That's a jump from the 15 to 20% range we've seen over the past few years. Among public funds, we see a similar trend, with 21% looking to increase their gold exposure. So after several years of record gold buying, that trend is set to continue. But what's the main reason? So diversification is the top driver, but protection against geopolitical risk is rising fast and driving this demand in both the short and the long term. And it's not just gold. More broadly, reserve managers are clearly shifting towards safe haven assets, and we'll see this in the next slide. This chart shows how central banks expect to adjust their holdings across different asset classes over the next 12 to 24 months. At the top of the list, we see gold and conventional government bonds, Once again, we're seeing a doubling down on traditional reserve assets, which means safety first. Appetite for higher risk assets like corporate bonds, equities, and asset-backed securities is much more muted, all below 15% on a net basis. That's mostly coming from advanced economies and actually a bit lower than last year. Linked to the broader theme of safety, we find that the most in-demand government bonds are those with 2 to 5 year maturities, and nearly a third of respondents are prioritizing the highest rated sovereign debt. Now, looking further ahead over the 10-year horizon, gold still comes out at the top, but there's a notable shift towards diversification. There's a greater willingness to move into riskier assets, especially corporate bonds and public equities. Before we end this presentation, let's see what our poll of public pension funds and sovereign funds say on asset allocation. So this table shows how public funds are thinking about asset allocation over the next 12 to 24 months. There's a lot here, so let me guide you through it. The columns show the share of respondents planning to increase, maintain, or decrease their exposure to each asset class. The number in brackets show last year's result, and any increases are highlighted in green. I'll break this down into 3 key takeaways. The first takeaway, illiquid assets remain the most in demand. Infrastructure still leads, with 1/3 of respondents planning to increase allocations, even though that's down quite a bit from last year. Real estate and private credit follow closely to the latter, and despite some cooling, there's still strong interest in illiquid assets. Second takeaway, funds are clearly in a wait-and-see mode. Across almost every asset class, the dominant response is to maintain current allocation. In today's more volatile environment, funds aren't rushing to reposition, they are holding steady. And finally, the third takeaway, we see a clear pullback from public equities. So only 13% of respondents plan to increase their equity exposure, while 20% expect to cut back. That's a sharp drop from last year. It reflects a broader risk of sentiment. And about half of public funds now say they have a bearish view on markets, and some of that is linked to the growing doubts around the US outlook. So where do public funds see the most attractive opportunities right now? Among developed markets, Germany comes out on top. It was picked by nearly half of the respondents, a notable shift from the US, which had traditionally dominated the space. Sentiment around the US exceptionalism seems to be cooling because 53% of funds now say they believe it will not continue. Germany's appeal is likely reflects optimism around its industrial and infrastructure outlook, as well as the lifting of its debt brake. As for emerging markets, India remains the top pick for the 3rd year in a row. To conclude, heightened geopolitical and economic uncertainty is promoting more caution. Central banks are looking to reduce risk, increase liquidity, and accumulate reserves, while public funds are in a wait-and-see mode. Doubts on the dollar are rising, but it will continue or it will remain the dominant reserve currency. Finally, central banks seek safety in gold and government bonds, and many are looking to diversify over the medium to long term. To wrap up, thank you all for your attention. This concludes my presentation. You can now download the full report by scanning the QR code for additional insights and deeper analysis. Now I'll hand it over to begin the panel discussion, where we'll dive deeper into some of the key findings. Thank you.
Thank you, Yara, for taking us through those findings. Clearly, it's a very tricky time for central banks and public pension funds and sovereign funds, and many are seemingly looking to diversify their holdings right now. I'd like to welcome an expert panel to explore in more detail some of the key themes we've just heard from our reports. Joining us today is Larry Hathaway, Global Investment Strategist at the Franklin Templeton Institute, Daniela Klingerbiel, Investment and Government Expert and former head of the World Bank's Reserve Advisory and Management Partnership, Jan Kubicek, board member at the Czech National Bank, and Isaac Muhanga, Director of Financial Markets at the Bank of Zambia. Thank you all for joining us today. And over the next hour or so, we'll be digging deep into three key themes in particular: the macroeconomic or perhaps the geopolitical environment and how that's playing into investment strategies. Some thoughts on asset allocation, and I think we'll go into a bit more on gold there, which we've already heard is seemingly attracting a lot of attention by the central banks, as well as currencies and questions over the dollar and what the alternatives may be. Before we get stuck into the discussion, just like to address the audience here that please feel free to ask questions throughout the discussion. You'll see a chat box in the Slido box beside the recording, and I can already see one or two questions already coming through there, which is great to see. And I'll try and feed as many of them to our panelists within the next hour, either interspersed within the conversation itself. Otherwise, we have some dedicated time towards the end of the conversation for a Q&A. I think that's the housekeeping out of the way, so let's get started. And Larry, I'd like to start with you. We've heard from Yara that geopolitics really has become front and center for reserve managers' minds when they think of the global economy or the macroeconomic environment. I think particularly around the time where we started the survey around March and May, which overlapped with April and Liberation Day. How do you see now, where we are today, geopolitics shaping investment strategies, particularly for the central banks?
Certainly. First of all, it's a pleasure to be here. Thank you for having me. Intriguing question, obviously one for our times. You note obviously the uncertainties of the April-May period, which were largely around U.S. Trade policy, around the sort of rapid and rather sort of discontinuous introduction of tariffs and some other measures. And of course, there's been the dark cloud of conflict worldwide, but most recently, of course, in the Middle East. If you look at, say, word searches for the word uncertainty or similar types of sort of messages, they've obviously jumped during this period of time. How do market participants think about that? Well, I think there are a couple of observations in order. First, if we really narrowly focus on uncertainty, uncertainty is different from risk in the sense that it is an unknowable. It's not something that we can easily calibrate or measure. And that, of course, has a long tradition in the history of finance and economics, but perhaps it can be thought of also in a slightly more different and up-to-date fashion insofar as some of the sources of this uncertainty are in fact novel, right? It's been a very long time since we've had tariff levels at the levels that have recently been announced, even if some of those have been pulled back. So we really don't have, let's say, modeling capabilities based on sort of a nice series of history to be able to assess not only perhaps their direct impacts that we might think of through price mechanisms, but also the indirect impacts about how they could affect behaviors around investment or sentiment or other things that will impact the fundamentals that drive asset prices. So I think it is important to focus on this being a time of uncertainty where we have this sort of immeasurable quality to it. And lastly, from a point of view of how then investors of all types, official institutions and others, manage that, I'm sure we're going to hear more about it in the course of this upcoming discussion. But suffice to say that uncertainty typically means that we withdraw somewhat, we increase our provisions towards very liquid assets, those that we perceive at least to be liquid, into so-called safe havens. And that explains to, at least in some part, what we have heard just now about, say, the role of the dollar. But it may also lead towards some greater desire, especially amongst official institutions, to diversify holdings by currency and by asset type in ways that maybe were not seen in earlier episodes. So those are a few sort of introductory remarks in response to your question.
Great. Thank you, Larry. And yeah, we'll dig a bit deeper into some of the specifics on asset allocation and currencies very shortly. Daniela, I want to come to you next about sort of bridging from what Larry said about, in many ways, the immeasurable uncertainty and how central banks navigate the space? I mean, if you were to, I know you still work with central banks, but maybe if you were to put yourself back in the position of leading the World Bank ramp program, and central banks were to come to you and saying, "How do I navigate this uncertainty?" What advice would you have?
Thank you. Thank you very much for having me. And despite the fact that we are seeing really high levels of uncertainty, I think central banks have, over the past 20 years, gone through uncertain and volatile periods, so they can draw from that experience. I think what I have seen central banks do is really focus on financial resilience, sort of strengthening the hedges, looking at their risk management operation, understanding how much risk they have on their books and whether they're comfortable with that via running different scenario analysis. At the same time, one could argue they have some cushioning given where yields are. So a very different position if you were to put that into comparison with 2022, when losses were not cushioned by the yields they earned on their fixed income portfolios. So focus on financial resilience. Specifically, that means
I think we've lost the audio for you, Daniela. Apologies.
I didn't.
Oh, yeah,
No?
no, it's back. Yep.
Is it back? Okay,
Yeah.
I will try. Sorry, all I was saying is focus on liquidity and safety and the ability to intervene at scale without market disruption really has taken precedent. Many are now willing to pay a premium to access liquidity in times of stress. There are a number of central banks that are securing contingent liquidity through swap lines. And if I remember one of your results from your survey, that also very nicely aligns with that. We also heard very similar continued gradual diversification. And we have seen, and my colleagues at RAMP have confirmed, that central banks are continuing to increasing their allocation to gold. As gold is sanction proof, there are no counterparty risk if held on site. And sometimes these gold allocations come at the request of the board, and they will be held outside the investment portfolio. And obviously, I don't know whether we will discuss it at a later point in time. Gold carries opportunity cost.
Mm-hmm.
It does not produce yield and can be operational complex. But why don't I?
Yeah, we'll come on to some of those more details of gold in particular very shortly. But yeah, thank you for those initial comments on. And Jan, I want to come to you on what Daniela mentioned there about sort of taking that liquidity and safety first approach and being more wary of financial resilience and risk management. Is that something you're actively looking to do within the Czech National Bank to help navigate the current market outlook, or what are the other approaches that you're perhaps taking to navigate these uncertain times right now?
Yeah, so first of all, hello to everyone from Prague. Well, maybe I should mention that the situation of the Czech National Bank is a little bit unusual in the sense that our reserves, well, currently are above 40% of GDP. They peaked even at 60% of GDP, which is by any metric much more than is recommended if we look at the ARA metric by the IMF. So our reserves are 3 to 4 times higher. So we decided like 6-7 years ago to split our portfolio into 2 portfolios. One is the liquidity portfolio and the other is so-called investment portfolio. And of course, the liquidity is very important and resilience is very important, but we believe that the liquidity portfolio, which is currently about 20% of our reserves, is sufficient to cover all these possible events. So we have always kept the liquidity portfolio very, very liquid. Essentially, these are just deposits with other central banks or very short-term government or treasuries, T-bills, and so on. So in this respect, today, we do not do any change, in fact.
Yeah. I suppose maybe just taking a big picture approach and something that Larry mentioned is in many ways it's trying to model the immeasurable right now when it comes to geopolitical risk. So when you're looking at sort of risk management, how do you approach that right now? How do you have that sense that that liquidity portfolio is enough for you right now, for example?
As I said, I mean, the volume is such that we believe that we will not need anything more. And after all, even the investment portfolio is mostly liquid. It contains mostly government bonds, which can be either sold or used as the collateral. So in this respect, maybe we are not a traditional central bank. But speaking about geopolitics, it's been important in our considerations for some time, especially with respect to China, because we had a Chinese portfolio, or simply put, Chinese government bonds, and they amounted to 2% of our reserves 2 years ago. But then our government has officially said that China is a strategic threat. So we decided to leave this portfolio, to sell this portfolio. And let me just remind you, 2 years ago, well, on the first page of The Economist, we had a title stating Taiwan and China, New Cold War. Today, it doesn't seem to be that important, but still there is some possibility of potential conflict. And so we decided not to have Chinese portfolio under those circumstances.
Yeah. No, thank you for that. I think that's a really interesting, concrete example of the interplay between geopolitics and reserve management, perhaps. And yeah, I think shortly I'd like to come to Larry and Daniela about sort of sanctions and other ways that geopolitics is playing out with financial markets right now. But before I get into that, Isaac, I wanted to come to you with a similar question. I mean, I know Zambia's own reserve position has improved in recent years as it's sort of come out of some of the shocks that we saw in the debt restructuring and supported by the IMF. But how are you looking at the risk management of your own portfolio right now? What are the key threats that you're looking out for? Oh, sorry, you're muted, Isaac. Thank you.
Sorry about that. Yeah, thank you very much for having me. And I'll say a little bit about that, and whatever I'm going to say really are my views. They do not necessarily reflect of the institution, but geopolitics still remains for us also one of the most important aspects, not necessarily for reserves management, but also for the sort of exposures that we have with the rest of the world. Zambia is a small open economy, and the materialization of some of these geopolitics affects us in very uncertain ways as well. And also the speed with which these risks are being coming to the fore gives a challenge generally around macroeconomic management generally, and more particularly with fiscal and monetary policies. And I say this because Zambia is a commodity-based economy, which is reliant much more on mineral exports. And so you can understand that whenever there is the realization of these geopolitical risks in the world, then the reverberations are also found in the commodities, and so those filter through government revenues as well as the way we think about monetary policy as well. Of course, when it comes to reserves management for us, we look at it as a safety net in the sense that the more reserves we have, the more resilient we can be to withstand some of these particular shocks when they hit the economy. So, of course, it informs us also on how we go around allocating assets across currencies. There is a lot of talk around diversification, and I think in the traditional way of thinking about the strategic asset allocation, one of the most important aspects that come to our mind is which of these countries are we really exposed to in trade terms, and what sort of shocks are they likely to face, and how are they going to filter through to ourselves? And which brings me to that question of the importance of China in all this. And I think that China has, over the last decades or so, grown in importance, not just in the size of the economy, but also in the influence. So we look at it strategically from a resilient perspective, but we are also aware that the internationalization of the RMB hasn't fully completed. I think it's still going gradual. There is still a couple of capital controls to go, and those pretty much act as if they were brakes on this in case you needed some liquidity. As an alternative, I think we are also building our gold portfolio, although we do not at this moment think of gold in the strategic asset allocation sense. I think much more maybe separately. As we build more, we're probably going to think on how we are going to fit that into the traditional way of coming up with a strategic asset allocation. And I'm here talking about the risk return optimization frameworks and stuff like that. So we don't include that in. So it comes much more, I think, it tells you that our concerns are much more about making the economy more resilient to some of these geopolitical risks, even though we are not directly, but we are indirectly affected.
Yeah.
And the effects are certainly magnified much more, I think, for a smaller economy like Zambia compared to those others which have years of building their own safety nets. So let me end there right now.
Thank you for those comments. And yeah, I think that links to what Daniela mentioned before, that maybe gold is being looked at beyond strategic asset allocation. I think that's something we can come back to very shortly, and yeah, I'll get some of Jan's views from that, because the Czech National Bank is one of the central banks that have been building up gold within the strategic asset allocation, at least as far as I understand. But just taking a step back very, very quickly, in terms of, we've already heard a few interesting comments there on financial resilience. We heard from Frank earlier about perhaps the weaponization of the dollar. Daniela, you mentioned that gold's being looked at in a way of providing protection against sanctions and others. So it's clear there's quite a lot of geopolitical risks and ways that central banks are approaching it. I wonder, Larry, just coming back to you on some of this. When we think about the geopolitical risk, there's clearly the trade angle with the tariffs there. Are there any other angles that you think are important for central banks, whether it's sanctions or broader issues related to payment systems, for example?
Yeah, so in response to that question, but perhaps to the earlier discussion, maybe I'll make two observations. The first being that we are unfortunately seeing, and not just in this year, but in some years before this, some efforts to use the payment system as part of a political process, a geopolitical process. I refer, of course, to the use of kind of SWIFT and the Russian sanctions as an example of that. There are others as well. And over time, of course, to the extent that that is something that is either expanded or feared to expand, it certainly also will have some impacts on, again, not maybe just official institutions, but more broadly, how people are looking at the at the need for international transactions for cross-border capital flows and whether the mechanisms are robust enough. In so many ways, we are moving towards a more multipolar world, whether it's in national security terms, in economic terms. And it would appear that that might also be the case in financial terms. One must recognize that there is something called thick market externalities. A single payment system is preferable to many, just in the same way that other sort of, let's say natural monopolies are often the more efficient way to organize our affairs. But sometimes the reality of the world interferes with efficiency, and this may be one of those. I second the point. I just wanted, if I could, just to interject a bit departure from your question, though.
Sure.
Is the thoughtful comments that we've heard from Jan and Isaac just now. They embed an element of individual rationality, but potentially here about a collective failure or a fallacy of composition, if I may. That is, individual central banks, if we're thinking about those institutions, reserve managers, may endeavor to become more secure and safer by increasing their reserves. The primary way over time that one increases one's reserves is through running balance of payment surpluses. Obviously, one can invest well and grow them that way too, but that's simply not possible. It wouldn't be possible in its entirety worldwide, but even if it were only the United States that stood on the other side, what we're finding is a clear reluctance to be the buyer of last resort for the goods and services that create those sorts of possibilities for the rest of the world to grow their reserves. And therefore, I think it points to the fundamental challenge that we see of our times here is that while we are all subject to these same shocks, with Isaac's important caveat that they obviously have different impacts on different economies around the world, the individually rational response, whether of, again, official institutions or other investors, is not necessarily collectively the best outcome. Addressing these underlying sources of uncertainty would obviously be the preferred route to take, albeit, of course, with immense challenges beyond the scope, I'm sure, of this panel. But I think that point needs to be emphasized here. So I'll stop there with my response.
Thank you, Larry. Now, I saw Daniela, you were nodding along to much of that. I don't know if you have any comments to respond to what Larry said there.
No, maybe just compliment. I think you're absolutely right. Each and every central bank will not be able to increase reserves at the same time. They can look at the composition of reserve and further liquefy and make changes to the existing portfolios. And obviously look at, and I think we've heard that from our central bank counterparts, they can also look at something like reserve adequacy. How far along are we? And if they feel they are concerned about having sufficient power to intervene in markets, some of these central banks have secured swap lines. Now, nothing to say that this is, from an economic perspective, optimal. Absolutely not. And I think everyone is looking forward when that no longer has to be done. But again, I think central banks do have mechanism to deal with the uncertainty. And I think they're also monitoring, since we're talked about sanctions, SWIFT access, the freezing of reserve assets. They are at the same time monitoring alternatives to SWIFT. We've seen some trade invoicing in non-USD currency. It is expanding, and it's really aiming to currency match with trade partners. If you look at the last number I found, I think 55% of all trade is done in dollar terms. On the financing side, it's even that number is even higher. So from a macro financial perspective, moving away from the dollar also really necessitates that more diversified trade and financial flows. And some reserve managers that feel vulnerable might be evaluating jurisdictional risk along with liquidity and credit risk, the custody location, and look at sanctions neutral sanctions neutrality, what cannot be sanctions, given that even reserves, to a certain extent, have been weaponized with a freezing of Russian reserves. And I'll leave it at you.
No, thank you, Daniela. And I suppose another way that's playing out, and this maybe allows us to move on to dig deeper a bit more about the asset allocation, and I'd like to come to Jan about gold, but sort of bridging on from what Daniela mentioned about maybe sanctions proof or sort of being more wary about the location of some of these reserves. I think that there was a headline earlier this week about, I think it's France and Italy looking to maybe repatriate some of their gold holdings from the US. That's something that we've seen from, I think it was 16% of our reserve managers in the survey said they're looking to do the same. So it's not necessarily just looking to increase the share of gold in the reserves, but actually doing more, increasingly so, holding that domestically. And so interested in your thoughts on that, Jan. I know you've been on a journey in the last few years to gradually increase the level of gold in your own reserves. Interested to hear your thoughts on why that's the case, and whether also the location of those gold holdings is also something you're considering.
Yeah, so as you said, Nikhil, our decision to increase our holding of gold was within strategic allocation. Well, the Czech National Bank had virtually no gold before, for 2 or 3 years ago. And we found out that really some amount of gold helps us with diversification, that we reduce total volatility of our portfolio, I mean the investment portfolio. And at the same time, well, as Daniela said, we know that there are opportunity costs, although I must say that the price of gold generated such a big profit for us that it more than offset, obviously, the opportunity costs. So yes, we found out that roughly if we invest about up to 5% of our reserves in gold, then it does contribute to lower volatility. But obviously there were some geopolitical considerations as well. We decided on increasing gold after the war in Ukraine broke out. Maybe I could remind to the audience that about 4% of our population are now Ukrainian refugees. So the country is relatively close and was very influenced by the war. As for the location, that is an interesting point. We openly say that most of our gold is with the Bank of England. This is no mystery, because, well, we don't have, operational experience with such big amount of gold, or relatively big, and we hope that this particular counterparty is safe.
Yeah, I'm sure those across the street from us here at the Bank of England will be pleased to hear that. Just one follow-up question very quickly. We've had one from the audience on gold saying that it's sort of low correlation, very little credit risk, no sanctions risk, and historical risk is very similar to equities, and sort of asking how you look at maybe the expected risk return over the next 5 years, and perhaps the next time you come to doing your strategic asset allocation. How are you looking at it on a risk return basis?
You know, we essentially think that there is no systemic return on gold, which is not true in the last 20 years, we know. But really the reason was diversification of our portfolio. It seems to work, and it did work in the last 2 years. So from this point of view, the diversification effect is more important for us.
Sure. Thank you. Isaac, you touched on it earlier, but saying that you're sort of looking at gold now as a diversifier, perhaps outside of your strategic asset allocation. Could you maybe give a bit more details about how you're thinking about the asset class right now? I'm sorry, you're muted, Isaac.
Great question. Thanks. So one of the things that Zambia is thinking through alongside several other countries, I think on the African continent, is how they can accumulate gold from their own resources. And I think that what is happened for those other relatively advanced economies who may not have had gold before is to basically exchange hard currency for gold. In our case, I think there is increasingly more and more gold being discovered inland, and I think the central bank has been given this role as one of the buyers or ultimate buyers of this particular gold. Of course, there comes in other operational issues such as refining it to bullion so that it can meet the liquidity of a typical bullion gold as well. Yeah, so in that process, I think what actively comes to the mind is not so much metrics as my colleague from Czech National Bank has pointed out to say, okay, is it going to be 5% or is it going to be, but certainly this is something us as reserve managers have to think through actively versus decisions that are made, for instance, by other parties as well, other policy makers. Like I pointed out earlier, this issue is motivated much more about the macroeconomic resilience. And so at what point do you, how much reserves do you need to be resilient? I think the thinking right now in our country is that more is better than less. How much more, I think, is still debatable. We have those views ourselves as official reserves managers, of course, but also it does affect how we conduct the other policies such as monetary policy, because this gold which I'm talking about, which is dug out of our national soils and then bought by the central bank, is only bought using local currency. So if you're gonna do that, there has to be a limit, because you have to face these challenges of monetary growth and the inflationary, the inflation implications that come with it. So those are very active policy issues, which we are still thinking through, other than the issue of geopolitics. But of course, all this came out following the frequency of these geopolitical risks, like I pointed out earlier. How do we go about making ourselves resilient without necessarily having to face a balance of payment surplus, as it were? Because if you don't have a surplus, then it means that you have to run down your reserves, probably to fend off your economy. But if there is a chance that you can accumulate gold in that manner, I think that has been found to be more efficient. So
I suppose
from that perspective, that's what's going on.
Which harks back to Larry's comments of not everyone can run a surplus by definition, so and accumulate reserves that way. Larry, I want to come back to you on, I suppose. Oh, sorry, Daniela, if you have
I just since I don't know, did you want to move back away from gold? I just had
but if you have something on gold, please go ahead.
Just a couple of comments more that there are liquidity constraints in gold. That's why you do see limits of central banks' willingness to hold gold, because if you have to offload at scale, you will have a market impact, and it's not that easy. So I just wanted to quickly make that point.
Yep, a fair point. And I know it's something you've mentioned to me as well, of gold is not necessarily safe in terms of reducing volatility in many cases. I suppose what we're mentioning liquidity and safety, at least historically, a lot of that was thought of in terms of US Treasuries, although perhaps there's now increasing question marks on that. And Larry, some of your colleagues at Franklin Templeton wrote in the GPI for a report this year about some of the struggles that the US Treasury market might start encountering when it comes to liquidity challenges with persistent government budget deficits, some of the infrastructure and regulatory frameworks in the Treasury market, for example. So how, yeah, I'd be interested to hear your thoughts on some of that and either the functioning of the Treasury market and maybe where you see the evolution of yields going forward.
Right. Yeah. So, as I think everyone knows, the sort of most liquid market in the world traditionally has been the U.S. Treasury market, perhaps rivaled by the U.S. equity market. But that's usually off limits to many reserve managers, or at least their proportions in equities would be quite small. So the focus here really is on treasuries. We have a number of sort of factors at work there that are sort of percolating along slightly beneath the surface. Occasionally, we've had some maybe ripples of liquidity issues in the markets, but they've been rather infrequent. Even if we went back, say, to the 1998 financial crisis, we saw a fairly significant widening of spreads between on-the-run and off-the-run treasuries as examples where this is possible, right? It is possible to see at least the difficulty in perhaps in transacting certain parts of the treasury markets. It's not just a theoretical argument. There is some evidence, but it's rather infrequent. I think the concern that a number of us have had over the course of the last 15 or so years is that as a consequence of the regulatory changes that were introduced following the GFC, very understandable, in many cases, very necessary changes that were meant to bolster the capital position of investment banks in particular, but other sort of financial actors within the system, and also some of the capital requirements that they tended to reduce the amount of warehousing of all forms of securities, including treasuries, by those same primary dealers and or other intermediaries. Meanwhile, and you alluded to it in your question, the size of capital markets overall, whether we're looking at, say, the fixed income component that's comprised of treasuries or whether we look at public credit securities as well, has grown rapidly, and their use of treasuries in particular has also grown rapidly as forms of collateral, repo, that sort of thing. So that we're having a number of institutions unable to warehouse as much of that in the sense of market making capacity to act as that broker to facilitate the buying and selling of securities at the same time that the market is mushroomed. And of course, since the pandemic, we've seen the arrival of persistent large US budget deficits, which seem to now extend as far as the eye can see, and particularly under the so-called Big Beautiful Bill. That seems to be also something we can count on for at least the remainder of this term of this presidency. So with all of that said, you have a large market that requires facilitation, but perhaps some impairment, if not on an everyday normal functioning basis of that market. Should we arrive at a situation which, for whatever reason, there seems to be some large scale, let's say, movement of assets through the market, maybe it's liquidation efforts by certain individuals to acquire liquidity, perhaps it's a rush to buy in a safe haven circumstance. One can imagine different scenarios. I think there are legitimate questions about the ability of the market in the short run to facilitate that kind of volume of activity, to provide the liquidity that is almost the unspoken truth of so many investors, that they can always rely on treasuries as that ultimate form of liquidity. We hope that remains the case. I don't want to say that we're forecasting something that is with any degree of certainty that can happen. But I think what we're really trying to suggest is that there may be some fragilities in the underlying workings of the system that all actors who are counting on treasuries to be that liquid safe haven asset ought to at least explore carefully, understand whether there are risks there, and act accordingly.
Yeah. No, thank you. And I think that alludes to a question we've had from the audience about how the high level of debt in not just the US, but a number of developed economies has maybe changed the composition of what a safe asset is right now. And obviously, we've seen the downgrade by certain many ratings agencies for US debt, for example. And maybe Jan, that's something I can call on you on. You mentioned already that the fixed income is still a key part of your portfolio, albeit that you've diversified into many other asset classes. Are you still seeing that either US Treasuries or other government bond markets as still safe in that sense?
Well, yes. But of course, we do see that, for example, credit default swaps of the American debt is more similar to that of credit default swaps of Italy currently than of Germany, which is something unheard of, I think. So for the moment, we do not do any change. As Larry has also mentioned, this big beautiful bill, which doesn't have a final shape probably, but this is something that will have potentially big influence on our American portfolio, because up to now the central banks rejoice zero taxation, to put it simply, and this may radically change. So I think we will have to reconsider it, and we will see. For the moment, nothing changes, but of course, these are things that we will have to rethink.
Yeah, no, interesting. And just to come back to you on diversification more generally, you're probably one of the more the central banks who's furthest along that journey in diversifying to other asset classes beyond government bonds. In particular, I think equities is over 20% of your reserves right now. Maybe you could share some insights with many of the central banks who are in the audience today about what that journey's been like and the role that equities play in your portfolio right now.
Mm-hmm. Well, this journey has begun 17 or 18 years ago, and it was because the volume of reserves simply was much higher so than we thought we needed. And at the same time, of course, there is one aspect that our reserves are essentially borrowed, in the sense that in our liabilities, we have debt towards local banks, which is roughly the same as our FX reserves, but in different currency. Well, 18 years ago, we decided to invest up to 10% of our reserves in equities. We chose external asset managers. Gradually, we found out that we are able to manage the equities internally. So now all the equities are managed in-house, and gradually we increased a ratio of equities up to 20%, and last year we decided to increase it up to 30%. But this, of course, is due to the relative size of reserves. So by and large, our experiences are good. And also I have to mention that we just have passive replication of indices. We have 6 currencies in our reserves. So we chose American index, Canadian, Australian, Japanese, British, and a European index. And our dealers passively replicate those indices.
Right. So, yeah, thank you. Isaac, I suspect it's at an earlier stage of that journey towards diversifying your own portfolios. You've already referenced perhaps looking more towards renminbi-based assets. You've already mentioned gold, although that's perhaps beyond the strategic allocation. How are you looking at diversification within your reserves more broadly?
I think in the long term, currently it won't change much. Let me talk a little bit about currency allocation. For instance, most of our payables are still in US dollars, and even though we have increasing trade with other non-US countries, who have their own currencies, but still we continue to settle those things into US dollars. And so naturally, we tend to think of reserves whenever we are looking at payment as one of the factors determining that in terms of the US dollars. But going forward, of course, given the issues that are surrounding the world today, a lot of uncertainty as well, and just to make reserves management more efficient, I think countries that we are exposed to in terms of trade will increasingly become more important. And we're thinking that as China continues on this journey to internationalize its currency, and slow as it is, it will play an important role in many countries' reserves management, and Zambia is included in those countries. So on the long term, of course, we watching closely what's going on in this space, and we are also learning from the experiences of others, and we also have to grow our own exposure to that particular aspect. And I think when we're thinking of currencies, then we think of them much more holistically, and which is a more efficient allocation as ourselves. So our allocation policies here are a function of how much trade we do currently, and with who, and in what currency are we going to do it. So that's what motivates and informs us what sort of currency exposure we'll build. Yeah.
Thank you. Maybe Daniela, I can come to you next on another currency in the euro. And we heard from Frank's comments earlier that maybe Europe needs to do its own homework and trying to rebuild its own market infrastructure, for example. But we do see more appetite from central banks to move towards the euro, perhaps as an alternative to the dollar in the near term. We've had a question from one of the audience members about joint euro borrowing, and maybe do you see that as a precondition to the euro gaining more dominance in global reserves, or is a lot of that linked to, say, what Isaac mentioned there about just pure trade links, perhaps? Oh, sorry, you're on mute, Daniela.
Sorry, I think trade links obviously are an important component in decision making in terms of the size of the allocation. I think interesting with respect to the European market is that it's significantly smaller than that of the US, and you have quite a bit of diversity in terms of credit rating. Germany has the lowest debt to GDP ratio, is with 18%, the second important issuer, but only 50% of outstanding bonds are actually investment rated, or A-, let me be precise, rated. So even if you had the capital union, very important to achieve that, for central banks to look at Europe or to have to achieve more liquidity. But at the same time, the difference in credit rating will still be there unless Europe moves further along to a European fiscal union.
Yeah, thank
you. So at this point, it is the second most important currency, but it just has some structure. It faces some structural issues.
Yeah, and Jan, I suppose a similar question to you and how you're looking at it in your own portfolio. I think you've already suggested there's maybe question marks over dollars. I think the euro is the second largest currency component of your reserves right now. What would it, maybe a hypothetical question of what would it take for you to be convinced that the euro is an area you'd want to move towards?
Well, euro is the biggest today. Even today, it's 50%. And within the liquidity portfolio, that is the intervention portfolio, it's 90% usually. So it is the biggest currency in our portfolio. But as Daniela said, it's true that I mean, what is euro? I mean, the bonds are not quite comparable. Italian bonds are not possible given our conditions because the rating is simply not enough today. So yeah, we think that our fixed income instruments denominated in euro are a little bit too concentrated, according to my view, and according to the ratings of individual countries. That is true.
Yeah. Thank you. Larry, sort of changing tack slightly, but I suppose it's linked to this currency area, and you've already mentioned that probably the treasury market should hopefully stay safe and liquid, and maybe that will help to underpin the dollar's role in global reserves. We've had a question from the audience, which is on a slightly different track, about stablecoins and their use in the global financial system, and whether dollar-backed stablecoins are likely to strengthen or weaken the dollar status within global reserves. I don't know if you have a view on that.
Oh gosh, that will probably take me to my limits. The introduction of stablecoins itself is fascinating. I'd be kind of curious to see perhaps how some of the other panelists view it from the point of view of the dimension of reserve management, but as a broader, let's say, innovation and potential sort of store of value asset class. There are a few things I suppose should be said. The first is the stability, of course, is by fixing their rate to an underlying national currency, US dollar being an obvious choice there. For the holders of the stable coin, you have to ask, what is the benefit of doing so? That you're giving up some opportunity cost of investing precisely in what is the collateral that backs that stable coin. So it feels like a negative carry type of position. You may get a little bit lower transactions costs at some point for a kind of cross-border payments. This almost feels like more of a retail issue than a wholesale one or an institutional one. We may be moving over time towards innovations in the middle back office area, towards blockchain technology to facilitate transactions. You participate in that, but it's not entirely clear to me how that confers a certain utility or a certain benefit to you. I'm somewhat therefore fascinated by some of the interest in the space because I actually don't see a great deal of the utility or the value for the holders. Why not just hold the underlying asset and be able to invest in some interest-bearing assets using it rather than through a stable coin? There is, of course, anonymity of transactions, which is both perhaps a blessing and a curse, depending on what types of anonymity is being required by the users of those things. So for that perspective, I'm still rather skeptical about sort of the widespread diffusion of these types of instruments at this current stage of their development. But I'd be curious to see how others on the panel might whether they take a different view, as it were.
Yeah, and I think Daniela is a good chance to bring you in. You wrote an article in the piece with some of your co-authors on crypto assets more broadly. I think a lot of that was focused on Bitcoin and crypto currencies and perhaps why they're not suitable for reserves. That'd be interesting to get your views on, as well as the stablecoin question that Larry's just touched upon.
Let me just begin by saying I fully echo what Larry has said on stablecoins, and maybe just a couple of risk for an investor in these stablecoins. There's still legal and counterparty risk. They're vulnerable to peg breaks. The Terra USD collapse in 2022 is an example. And at this point in time, they still somewhat operate outside the system. So there's not a clear regulatory framework in terms of consumer protection. And they depend on private custodian and a blockchain infrastructure that is, for anybody investing in stablecoins, should have an assessment on the credit risk of the issuer, and to what extent the backing the issuer can credibly back that that it is maintained. Now, let's move to, thank you very much for the question on other crypto assets. And we look at Bitcoin. This is the most well-known, issued in 2009, with a fixed ledger, and originally conceived to be a payment mechanism. Did not have in the end, ledger technology at that point in time did not prove resilient enough or fast enough to be used for payments. But maybe for the audience to understand, crypto assets really have three important design features that are crucial to understand to what extent can they become a suitable asset. One, that they solely exist in digital form, that is, they're digital native. We heard about that they employ blockchain-based transactions, so they're verified through distributed ledger, and they're issued by non-sovereign and operate independently from governments and central banks. So we deem private crypto assets as not suitable for inclusion. And if you wanted to read up, there is an article in the current issue for inclusion. They're not liquid enough and costly to trade. They're highly volatile with extreme price swings that are incompatible with safety objective of reserve management. They operate in an uncertain and evolving regulatory environment. While custody solutions are improving, and there are some solutions that may be manageable, that is, custody solutions are an important area that's not quite fully resolved. But very importantly, crypto assets are not integrated into global trade and capital flow, and therefore do not provide any reasons for central banks from an asset liability point of view to hold crypto assets in their reserves. And lastly, in terms of do they count against reserve requirements, the IMF has reconfirmed that crypto assets do not qualify as reserves.
Yeah, thank you. Yeah, a very sort of comprehensive overview there as to why it's perhaps not suitable in reserves. Although, Jan, if you don't mind, I'm going to come to you as perhaps you already know why, in that your governor suggested earlier this year that maybe Bitcoin is something to think about within the reserve portfolio. I'd be interested to hear your comments as to how you're thinking about that at the Czech National Bank.
Mm-hmm. Yes, as you said, Mr. Governor has said that we could just explore it in more detail. So we are preparing a broader study on alternative classes of asset classes, and one of the asset class is essentially Bitcoin. Well, the idea is that okay, we can, as a central bank, pretend that there is no such a thing as Bitcoin, or we can gain some hands-on experience with it, which obviously doesn't mean that you have to buy, I don't know, 2% of reserves in Bitcoins. Well, as Daniela has stated, several very serious reasons why crypto assets today are not suitable as reserves. I agree with many of those reasons. Well, what we find out, unsurprisingly, that Bitcoin is so different from all other kinds of assets we have that it would really stretch our operational abilities concerning accounting, auditing, everything to the limits. Still, we leave the question open. We think we will decide later this year in the autumn whether it's worth trying it or at least experimenting with Bitcoin and not exposure to Bitcoin, because today we could buy some ETF, but that's not the experience really then. Well, if I may respond to what Daniela said, the thing that really the price of Bitcoin is extremely volatile is, of course, a disadvantage, but one has to see it in the context of the whole portfolio. I mean, if there were, hypothetically, some correlations which would offset other volatility, then volatility of Bitcoin by itself wouldn't be a reason why not to include it. But I must openly say, and the audience knows it, that we didn't find any miraculous stabilizing force of the Bitcoin for the moment. And of course, there's a big methodological problem how to really explore it, because it seems that the behavior of Bitcoin is changing precisely because it is more and more financialized. So the past information may not be relevant for the future.
Yep, thank you. Spoken like a clause in what every investment manager would say at the end. But Isaac, I don't know if maybe you have a view on what we've just heard on crypto, but otherwise we've had a question also come in on another type of asset class that central banks may be considering, which is ESG assets. It's something that we've seen in our survey. About a third of reserve managers are looking to add to green bond holdings over the next few years, either in terms of crypto or maybe green bonds. Are these sort of new emerging asset classes something you're considering right now?
Yeah. Relatively, we are early in thinking around this, but I think that the thinking is growing much faster than I expected myself when it comes to thinking. When it comes to investments in ESG bonds or related assets, not just for reserves management per se or public assets, but also from a strategic perspective, because climate change for us matters a lot. And again, this is one of the sources of macroeconomic volatility for a country like ours. So when there is a discussion around ESG sorts of investments, I think it becomes attractive to us, because then you attract more resources in trying to make things that that matter to you as far as climate change is concerned. Zambia is just coming, like in your introductory points earlier, I think we're just coming out of a debilitating drought, which really pushed inflation up, growth was lower, it raised the poverty levels, exchange rate was. So all these things, when you put them together, they answer to the question of how should the world be thinking about ESG. So in our own small way, I think that when we think actively and promote these sorts of investments, I think then there is a wider community that believes that there is this sort of support even from us who face these challenges much more critically than others.
Yeah. Thank you. Unfortunately, we're coming towards the end of the discussion here. I'm sure we could go on for much longer, which I think is a sign of a great discussion, and obviously a lot of detail we've already covered. But I'd like to end on one final question to the four of you. It's slightly more tongue-in-cheek question here, and I'll give you perhaps 30 seconds to respond. Is on the future of the dollar. Right now, it's just under 60% of global reserves. And one question we asked in the survey is, where do central banks think that will be in 10 years' time? So that's a question I'd like to ask the four of you. So we're at around, I think it's 57% now. Maybe Isaac, I could start with you. Where do you see that figure being in 10 years' time?
I think my view is that it's a long way really to displace the dollar as the currency of preference in many reserves. I mean, just doesn't. I mean, even with the proliferation of all these geopolitical risks that we're seeing, I think many, and I belong to that group that believe that, you know, these are probably transitory issues. At every point in time, you are going to have these geopolitical risks and conflicts and stuff like that. Whether they'll stay and become as important as the World War II, for instance, was, to change the course of history in a very meaningful way and to change the course of economic history as well. I'm not sure there is a conviction on my part. So
shall we go with above 50% for you then?
Yeah. Oh, sorry. You gave me a few seconds there.
Sure.
Yeah. So I think it will still be quite over 50%.
Great. Thank you. Jan, the same question to you.
Well, I do think as well that the dollar will remain the reserve currency, but as Larry has mentioned in the beginning, other currencies will emerge, probably a Chinese currency or some other emerging countries. So for this reason, the weight of dollar will decline. So if I'm forced to say speculate, in 10 years' time, 47.
Great. Well, we've got under 50% there. Daniela, for you.
I would have said 47 as well, but just to be
very
different,
good.
I'll say 46. No, I think the dollar, the US offers the most liquid and deep market. And I think Europe, I think Europe just has structural issues. Maybe they will get it together. If they get it together and they do form one capital market union and go further along a fiscal union, maybe it can become an alternative, but I tend to be more skeptical on that side. For emerging market countries, currencies to become more important, they need full convertibility. I think for renminbi investor, not being able to repatriate the currency when needed is the major issue. So I can only see that if these countries have full open capital account, that also the same holds for India as well.
Yeah.
Yes.
So
I think you will gradual diversification also into smaller reserve currencies.
Yeah. Thank you. I guess a simple question there for you, Larry, of higher or lower than 46 or 47?
I'll take somewhere in the midpoint. I do think that the dollar's role is declining, perhaps a bit in its own right, perhaps because of alternatives that are arising. I think the diversification arguments in many respects will also drive that process. So, but I'll say it certainly will be the plurality, but it's probably going to be just over 50% in 10 years' time.
Great. Thank you very much. And with that, unfortunately, that ends today's panel discussion. Thank you all to Larry, Daniela, Jan, and Isaac for your really insightful comments over such a range of topics there. And I think it exemplifies just the range of topics that many central banks are just having to deal with right now. We've touched on geopolitics, the role of the dollar, whether the euro will emerge more prominent, the renminbi, other asset classes, whether that's equities or perhaps even crypto assets. So thank you all for your super insightful comments. Thank you to our partners more generally on this global public investor work, to Franklin Templeton, who you've heard from today with Larry, to DZ Bank, and you heard earlier from Frank Scheidig there, as well as CCB. So it just leaves me to finally thank my colleagues here at OMFIF for all their hard work and effort in putting together not just the publication, but also today's event. We'll be continuing this work stream over the next few months. So please stay tuned to that. But yeah, with that, I would like to sign off and thank you all for today's event. Take care.
Thank you. Thank you.
Thank
Bye-bye.
you.